In your opinion, is financial success determined by intelligence or by behavior? If intelligence alone created wealth, there would be far more financially free geniuses today. If behavior matters, disciplined people would consistently outperform smarter investors. In The Psychology of Money by Morgan Housel, the answer is gradually revealed. Morgan Housel examines financial behavior through real-life stories rather than abstract economic theory. Unlike books that focus primarily on wealth itself, such as Rich Dad, Poor Dad, The Psychology of Money offers a completely different perspective on earning and spending money. The book uncovers the patterns behind fear, greed, and irrational decisions through 19 lessons. Let's begin with the first lesson. The Underrated King. The Power of Time. Warren Buffett, one of the most famous investors in history, owns a fortune worth tens of billions of dollars. And most of that wealth appeared in the later years of his life. Not because he discovered a magical stock, nor because he suddenly became smarter in middle age. It happened because he invested consistently over an almost unbelievable length of time. And time did what time always does. It compounded. His skill is investing, but his real secret is time. He started investing at the age of 10. And that is the miracle of compound interest. Every year you delay starting is a year of growth you can never get back. You don't need to be a genius. You just need to start early and never stop. The best time to plant a tree was 20 years ago. The second best time is today. However, for time to work the miracle of compound interest over decades, like it did for Warren Buffett, you must survive the unexpected events of life. You cannot reap the rewards of 20 years later if you are knocked out of the game in the 5th year by events that history could never have predicted. The illusion of history and the need for a plan B. If you're relying on past data for comfort, Housel has a warning. History won't save you. The biggest financial events, like 2008 or a global shutdown, are always the ones nobody saw coming. You can't predict the unpredictable. So the solution is to prepare for anything. This is why smart people always have a backup plan. A plan B. Most people plan for everything to go perfectly. But the winners are the ones who survive when their predictions are wrong. You must build your survival fund, 6 months of basic expenses today. That boring money that just sits there is what keeps you in the game when exciting plans fall apart. Another reason rigid long-term plans fail is that they are based on a flawed assumption about who will execute them. Housel calls this the end of history illusion, that we won't be who we are today in 10 or 20 years, and that this change requires financial flexibility. However, the greatest enemy that can destroy your Plan B and emergency fund the fastest is not a market downturn, but your own ego. When we try to use that reserve money to buy social approval, we are effectively burning our own margin of safety. This leads to a painful truth that Housel refers to as ego-driven spending. The Ferrari nobody really sees. Have you ever bought something expensive purely because you wanted others to think you were successful? That urge to spend is often fueled by a flawed assumption. We buy expensive things to impress others. But Housel delivers a painful truth. When you see someone driving a Ferrari, your first thought isn't, wow, that guy is so cool. Your first thought is actually, wow, if I had that car, people would think I'm cool. You're looking at the car, imagining yourself in it. The driver is essentially invisible. We chase expensive clothes, big houses, and fancy watches thinking they command respect. But most people just start wanting that stuff for themselves. The person you're trying to impress is probably thinking, I need to get a car like that. Even worse, people whose respect actually matters will often judge you negatively for flashy spending because they know an expensive car often means expensive debt. The lesson here is simple. Stop buying expensive things to impress others. Nobody cares about your stuff as much as you think they do. Stopping purchases made to impress others not only helps you keep your money, but is also the first step toward changing your core mindset about wealth. Housel believes that if you cannot control your own desire to show off, then no matter how intelligent you are, financial failure is inevitable. To demonstrate that one's attitude toward money matters more than IQ, he presents two completely contrasting examples of how behavior determines human destiny. The parable of behavior versus intellect. Housel starts with the tale of two men to prove that, in finance, there was a tech executive, brilliant enough to invent part of the Wi-Fi technology, who loved to show off his wealth. One day, he bought several $1,000s in gold coins and went to the dock with his friends just to skip them like rocks into the Pacific Ocean. This brilliant guy, with all his technical genius, ended up completely broke. Contrast him with Ronald Reed, a minimum wage janitor who simply saved and invested small amounts consistently throughout his life. When he died, he left behind $8. The lesson is stark. Finance isn't hard science like physics. It's a soft skill built on psychology. If you're serious about fixing your finances, you must stop looking for the secret strategy, and instead, to look in the mirror to fix the money habits and behaviors that are keeping you broke. This need to show off, that social vanity, is often the first behavior that breaks us. Once you have learned to look in the mirror to correct flawed spending habits and set aside vanity, like Ronald Reed, you have laid the first brick toward wealth. However, self-control is only half the battle. To truly begin the journey of building wealth, you must step into the world of investing, where psychology once again plays a decisive role. This time, in how you respond to the constant fluctuations of numbers. The price of entry, volatility, is the fee. Now, let's shift from spending to investing. Because even when you get the habits right, you still have to pay the price of admission. The stock market historically provides great returns, around 10% per year over time. But Housel reveals the catch. 94% of the time, you'll be watching your money go down. Even in a good year, where you end up with a gain, you'll watch your account drop on most individual days. That fear, stress, and doubt you feel, watching your money disappear for months at a time, that is the price of good investment returns. Most people sell during the drops, trying to cut their losses, and buy back in later, trying to get the returns without the volatility. But you can't sneak into the amusement park. You must stop seeing market drops as a penalty for making a mistake, and instead, see volatility as the fee you pay for getting life-changing wealth. Accepting volatility as the price of getting rich requires a complete shift in your expectations about accuracy. If you treat every downturn as a failure, you will give up quickly. But if you understand the true nature of investing, you will see that success does not come from being right all the time, but from staying in the game long enough for the big wins to appear. You will be wrong most of the time. If the volatility of daily losses bothers you, it's probably because you think success means being right all the time. But even the greatest investor who ever lived proves that idea wrong. Warren Buffett owned 400 to 500 stocks over his lifetime, but he made most of his money on just 10 of them. That means 98% of his investments were mediocre or bad. This is how success works everywhere. Most things fail, but a few things succeed wildly. And those few winners make up for all the losers. You can't predict which attempt will be the winner, so you need to keep taking shots. The winners aren't the people who are right more often. They're the people who can handle being wrong long enough for their few big wins to pay off. This perspective shifts the focus from finding the right stock to simply staying in the game. Perseverance allows you to stay in the game long enough to reap massive wins from a few correct decisions. However, when those victories begin to generate enormous wealth, you face an even more difficult challenge, preventing success from turning into unchecked greed. The danger of greed: knowing when you have enough, but even a long time horizon can't protect you from the silent wealth killer, greed. The story of Rajat Gupta is chilling. He was a CEO worth $100 million, truly never work again money. Yet, sitting on the Goldman Sachs board, he got caught up in the pursuit of more. He risked it all with insider trading to make an extra $17 million. He went from incredibly rich to slightly more incredibly rich. Then he got caught and went to prison. The hardest financial skill isn't making money, it's knowing when to stop trying to make more. As Buffett warns, people risk what they have and need for what they don't have and don't need. And that is foolish. Before making any financial decision, you must ask yourself that question. Am I risking what I have and need for what I don't have and don't need? You have to know when you have enough. Rajat Gupta's story illustrates that. Often, the pursuit of more simply ignores the role of opportunity. When discussing finance, we must confront the uncomfortable truth that success and failure are deeply intertwined with forces beyond our control: luck and chance. The twin forces, luck and risk. When you look at your own success, you often feel like a genius. And when you fail, you feel like a failure. But Housel compels you to admit how much luck is involved. Consider Bill Gates. He went to the only high school in the world with a computer. 1 in a million odds. His friend, Kent Evans, was just as smart, but he died in a mountaineering accident before graduation. Also 1 in a million odds. Luck swings both ways. Most people prepare for neither good nor bad luck, assuming good times will last forever. You can't control luck, but you can control how long you survive when bad luck hits. That is why you save that boring money. Your Things Happen Fund. Because when bad luck hits, you'll survive long enough for good luck to find you again. Once you know when to stop risking what you have, you then realize that keeping money is an entirely different skill set from making it. The fundamental difference: getting money versus keeping money. The necessity of survival is perhaps the most overlooked skill in finance. The trader Jesse Livermore made the equivalent of $3 billion in a single day during the 1929 crash, becoming the richest man in America. 4 years later, he was broke and took his own life. How do you go from $3 billion to broke? You confuse getting money with keeping money. Getting money requires risk and optimism. Keeping money requires the opposite: humility, fear, and accepting that what you made can disappear just as fast. People respect hustle, but they overlook the boring, cautious survival part. That's why Buffett is great. He never blew up. You need a $100 gain just to break even after a $50 loss. The lesson is clear: get bold to build wealth. But once you're ahead, you must shift to protection mode. When your focus shifts from the hustle and bustle to survival and protection, you begin to see the true, deeper value of money. If it's not about a $100 profit or a luxury car, then what is money really good for? Housel gives us a definitive answer. It buys control. What money actually buys: control over your time. If money doesn't buy happiness, what is it actually good for? Housel is definitive. It buys something more valuable: control over your time. The ability to wake up and say, "I can do whatever I want today," is worth more than any car, house, or vacation. Most people use money incorrectly, buying bigger houses and clothes, which creates more problems. They should be buying freedom. Freedom from saying yes to things you hate. Freedom from working weekends. Freedom from checking email on vacation. The people who win live below their means. Not because they're cheap, but because they're buying options. Every dollar you spend on impressing other people is a dollar that can't buy you freedom later. This concept of freedom leads us to a profound paradox. If the true purpose of money is to control time, and freedom is intangible, then what must true wealth be? Housel offers a crucial truth. True wealth is what you cannot see. The truth about wealth: it is invisible. This leads to a deep paradox. Real wealth is what you don't see. The author recalls Roger, the guy who drove the Porsche to the hotel where he worked as a valet. Everyone thought Roger was rich until his car was repossessed. He just had an expensive car payment. Meanwhile, Ronald Reed, the janitor in the rusty truck, had $8 million. Real wealth is the cars not purchased, the clothes not bought, the upgrades declined. It is invisible because it's just money sitting in an account growing quietly. We judge wealth by what people show us. But what they show us is often spending, and spending money means you no longer have it. Fake wealth is loud. Real wealth is invisible. If wealth is truly intangible and built on boring habits, then the question is, how to achieve this invisible, powerful state? The one wealth rule everyone ignores. If we cut through all the complexity, the only wealth rule that truly matters is this: spend less money than you make. That is the whole secret. You can make $200, 000, a year, and be broke if you spend $210, 000. You can make $40, 000, a year, and get rich if you spend $30, 000. The reason this is so powerful is that you have more control over your spending than your income. Saving money is like getting a raise that never gets taxed. The people who get rich aren't the ones who earn the most. They're the ones who save the most. Income gets you started, but your savings rate gets you wealthy. However, Housel quickly reminds us that life isn't a spreadsheet. While the formula for becoming wealthy is simple, its implementation is deeply influenced by emotions. What happens when a mathematically perfect choice keeps you awake at night? That's when you need to learn to act rationally instead of just logically. Beyond rationality, the importance of being reasonable. But Housel is quick to remind you that life isn't a spreadsheet. The mathematically perfect choice and the choice you can actually live with are often different. Harry Markowitz, who won the Nobel Prize for the perfect investment formula, invested his own money 50/50 between stocks and bonds. Why? Because he didn't want to regret whatever happened. It helped him sleep at night. This is called being reasonable instead of rational. You might pay off low-interest loans early, not because it's optimal, but because it brings you peace of mind. The best financial strategy isn't the one that looks perfect on paper. It's the one you can stick with when markets crash and you are scared. Sleep at night matters more than squeezing out an extra $1 return. However, even if you've found a reasonable strategy for the present, there's another variable that's always changing: yourself. What's reasonable today may no longer be suitable for you 10 years from now. The changing self. Flexibility is freedom. Another reason rigid long-term plans fail is because you will change. Housel talks about a high school student who worked relentlessly to become a doctor, only to call it an awful career later in life. Psychologists call this the end of history illusion. You think you'll basically be the same person forever, but your priorities will change. The career that seems perfect at $22 might make you miserable at $42. This is why locking yourself into rigid $40, Year, financial plans can backfire. Wealth is freedom. Not just from poverty, but from the past versions of yourself. You must stay flexible and build a life that lets you pivot. This flexibility also applies to how you select financial advice. When you seek advice, you must be extremely careful, because everyone is playing a different game. Their goals may undermine yours. The wrong game. Asking what game are they playing? When you seek financial advice, you have to be careful, because everyone is playing a different game. A day trader is trying to make money in the next hour, while a retiree is trying to make money over the next $20 years. They might be trading the same stock, but their goals are diametrically opposed. The danger lies in taking advice from someone playing a different game than you. The day trader on YouTube telling you to buy crypto is probably planning to sell next week. If you're planning to hold it for years, their strategy will destroy you. Before you take any advice, you must ask, what game are they playing? Only take advice from people who are playing your game, beyond external strategies and advice. There's a fundamental force shaping your financial reality, the story you tell yourself. Housel shows how powerful this psychological belief is, to the point that it can change your entire economic or personal destiny. The power of your internal story. Beyond strategies, there is a fundamental force shaping your money reality, the story you tell yourself. When the economy crashed between 2007 and 2009, it lost $16 trillion. But nothing physical changed. The factories, roads, and knowledge were all the same. The only difference was the story we told ourselves about the economy. If you tell yourself the story, I'm bad with money, you'll act differently. You'll take fewer risks. And that story becomes your reality. You need to write down the story you tell yourself about money and make sure it's a story that helps you instead of hurts you. And finally, once you've fixed your inner narrative, you have to be wary of the stories others are trying to sell you. Why is the news always full of war, collapse, and disaster? Because optimism is boring, while pessimism sells well. Why bad news sells better than good news? You also have to be mindful of the stories others are selling you. Why is the news always filled with wars, crashes, and disasters? Because optimism is boring. Pessimism is exciting. If someone says, the economy grows $3 this year, like it does most years, you shrug. But if someone says something negative about your stock, you stop everything. Your brain is wired to pay attention to threats that kept your ancestors alive from tigers, but it makes you a terrible investor when you're constantly worried about financial tigers that probably aren't there. The simple, powerful advice here is to stop watching financial news for $30 days. The world isn't ending nearly as often as the news claims. Housel's final plan: independence over optimization. Finally, Housel tells you exactly what he does with his money, and it's profoundly human. His goal is not to get the highest returns, but to achieve independence, the freedom to wake up and do what he wants. He and his wife live well below their means. They own their house without a mortgage, which Housel says is the worst financial decision, but the best money decision they've ever made. Financially, they should have invested that money in stocks. But emotionally, owning it outright makes them feel independent. They keep a large amount of cash, about $20, because they never want to be forced to sell investments when they need money. Every financial decision they make revolves around one question: does this help us sleep better at night? The point isn't to copy him, but to figure out what you want money to do for you and build a plan that is simple, flexible, and boring enough that you're not tempted to mess with it every time the market moves. After all the stories, Housel distills success for normal people into a handful of core lessons. Lesson 1. Behavior over intelligence. Financial success is not a hard science, it's a soft skill. How you behave is more important than how smart you are. A genius who loses control of their emotions can be a financial disaster, while an ordinary person with no financial education can be wealthy if they have a handful of behavioral skills. Lesson 2. Luck and risk. Nothing is as good or as bad as it seems. Success is a mix of hard work, luck, and risk. Realize that you are one person in a world of 8 billion, and many factors affecting your outcomes are outside of your control. Lesson 3. Never enough. The hardest financial skill is getting the goalpost to stop moving. Happiness is results minus expectations. Don't risk what you have and need for what you don't have and don't need. Lesson 4. Confounding compounding. The secret to Warren Buffett's wealth isn't just his skill, it's his time. He started at age 10. Compounding only works if you can give an asset years and years to grow. Lesson 5. Getting wealthy versus staying wealthy. Getting money requires taking risks, being optimistic, and putting yourself out there. Keeping money requires the opposite: humility, frugality, and the fear that what you've made can be taken away just as fast. Lesson 6. Tails. You win. You can be wrong half the time and still make a fortune. Anything that is huge, profitable, or famous is the result of a tail event, an outlier. A few small things account for the majority of results. Lesson 7. Freedom. The highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. Controlling your time is the highest dividend money pays. Lesson 8. Man in the car paradox. No one is impressed with your possessions as much as you are. You might think you want a fancy car or watch to signal respect, but people often ignore the driver and only imagine themselves in the seat. Lesson 9. Wealth is what you don't see. Spending money to show people how much money you have is the fastest way to have less money. Wealth is the nice cars not purchased, the diamonds not bought, and the assets that haven't been converted into stuff. Lesson 10. Save money. The only way to build wealth is to have a high gap between your ego and your income. You don't need a specific reason to save. Saving for a world that is inevitably unpredictable is the best reason of all. Lesson 11. Reasonable is greater than rational. Do not aim to be coldly rational when making financial decisions. Aim to be pretty reasonable. A strategy that is mathematically perfect but keeps you awake at night is a bad strategy because you won't stick with it. Lesson 12. Surprise. History is the study of change, ironically used as a map for the future. The most important events in the future will be things that have no precedent in the past. Prepare for the unthinkable. Lesson 13. Room for error. The most important part of every plan is to plan on the plan not going according to plan. Leave a margin of safety in your budget and your expectations. Lesson 14. You will change. Long-term planning is hard because people's goals and desires change over time. Avoid the extreme ends of financial planning. Stay flexible so you don't regret your past choices. Lesson 15. Nothing's free. Successful investing has a price, but its currency is not dollars. It is volatility, fear, doubt, uncertainty, and regret. Treat these as a fee for a better future, not a fine for doing something wrong. Lesson 16. You and me, beware of taking financial advice from people playing a different game than you are. A day trader has different goals than a 30-year index investor. Know what game you are playing. Lesson 17. The seduction of pessimism. Optimism sounds like a sales pitch, while pessimism sounds like someone trying to help you. Progress happens too slowly to notice, but setbacks happen too quickly to ignore. Don't be fooled by the doom narrative. Lesson 18. When you'll believe anything, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. Our personal stories of how the world works are often flawed. Lesson 19. All together. Now success is about humility and survival. Prioritize independence over being right. Use money to gain control over your time. And be nice to yourself when you fail. Closing this book, you realize it is not a guide to getting rich. It is a profound lesson in how not to self-destruct. You realize that money success is about behavior, not intelligence. That volatility is the necessary price you pay for wealth. That you must know when you have enough to avoid greed, the silent killer. And above all, that independence, not optimization, is the highest financial goal. If you want more deep dive book reviews that focus on the real psychology behind personal growth and success, make sure to follow the channel. And let me know in the comments below. Based on these stories, which of these crucial money behaviors are you currently struggling with the most?